Do you have pressing questions about your financial investments? Is there an investment with the security of a bond and the growth potential of a stock? What investment categories have outperformed others over the last 10 years? This series is designed to answer those questions and provide educational knowledge that we think you will find helpful for building a solid financial foundation. Welcome to Dollars and Cents Investing. My name is Emily Summers. This will be the first installment in an educational series of 3 seminars. Over the course of this series, we will examine questions like the ones above. We'll be sharing some wisdom about the economy, finance and investing, mixed with some common sense about your money. Whether you are an experienced investor or just getting started, we will be giving you valuable information to support your financial investments. Now, this seminar was inspired by the principles, insights, and interviews of wealth manager Michael Wayne Fineman. You may have seen him before on a number of financial TV shows or in New York Magazine, honoring him with the 2015 5-Star Wealth Manager Award. We were delighted when he agreed to contribute his time and knowledge to this educational project. Michael has 30 years' experience in finance with such world-class organizations as the Federal Bank Board, the United Nations, JP Morgan Chase, and Smith Barney. For the past 10 years, he has been Senior Vice President of Investments at Wells Fargo Advisors, working with individual and organizational investors over all those years. He has gained impressive insight into successful investing. During this series, we will connect with Michael's clear and simple insights into some of the most sophisticated and valuable investing ideas and information. Now, I'd like to introduce well-respected financial advisor Michael Wayne Fineman, Senior Vice President of Investments at Wells Fargo Advisors. Michael, welcome, and thank you for being here today.
Emily, thank you for those kind words, and thanks for having me. Welcome to all of you who've joined our seminar. My story is the same as many of you. I had a middle-class upbringing. My father was a World War II veteran. My mother was a homemaker until my brother and I were in college. I was born and raised in Brooklyn. I attended Madison High School and then Brooklyn College, and I still have many of the friends I had back then. I've been working as a wealth manager for a long time, but my original career goal was to become a scientist. My education was in physics and math, but to really get anywhere in that field, you need a PhD, and I needed to put away some money before I could pursue that goal. My math and cyber skills got me a really great job developing computer-based forecasting systems. Some of them worked really well, not every time, but well enough that I started investing my own money using my algorithms and a disciplined scientific approach. I found the field so interesting that I went back to school to fill in the gaps in my financial knowledge, studying managerial finance at George Washington University in DC. From that point on, I've been applying my methods and insights to managing investments for individuals and organizations. Here's an important question. What are the 2 most important things in your life? The average person would say, my family and my health. The 3rd item on the list should be your wealth. From my experience dealing with so many different families and individuals, I can't imagine a critical life event where having more money wouldn't have improved your situation. If you or a child needed medical care, money could mean the difference between life or death. As you get older, it becomes even more important. In today's world, your money is your life, and anyone who says money can't buy happiness doesn't know how to shop.
Well, that might well be true. But I think the problem is that most schools don't teach you anything about the fundamentals of investing. You probably spent more time learning about the French Revolution than how to handle your finances. Now, we call this seminar Dollar and Cents Investing because we are going to help you make sense of how to invest your dollars. Our goal is to level the playing field for you by sharing some of what Michael has learned from 30 years in finance and managing people's investments. He is going to share observations that you probably won't hear on TV or anywhere else you've been getting your financial advice. Now, before we start, we want to emphasize that this is a seminar and we will only be covering educational material. Many people get invitations to presentations which turn out to be nothing more than high-pressure sales campaigns. This seminar will not be anything like that. There will be no sales talks and no solicitations. We will, however, be covering a lot of information, so you might want to grab a notepad. Now, finance isn't easy, so Michael, how should people start?
Just as you said, Emily, finance isn't easy, and knowledge is the key. Investment management isn't a hobby. I'm in the market every day. I eat, sleep, and breathe investing. This is a business that runs on knowledge and experience, and the more you have of each, the better your results. It's not something you can pick up by reading a book on the weekend. I really love what I do because whatever news is happening in the world might have some effect on a company my clients own, a company we should own, or a company we should sell or avoid like the plague. As a result, you become very well informed, aware and connected. The hottest trends, the latest products, scientific breakthroughs, and corporate breakdowns. It keeps you sharp. In some ways, it helps you stay young by being abreast of what's happening now.
So it's definitely interesting to know about the outside factors that can affect the market. So from your opinion, what do you want people to get from this series?
There are so many things that affect our lives that are beyond our control. The weather, what's happening in Washington, or the guy driving the car in front of us. However, there are certain aspects of your life that you can and must control. One of the most important is your financial future. My relationship with my clients is as an educator and a financial counselor. I guide them to reach their financial goals. So my purpose for this seminar is to help empower our viewers to take charge of their financial future. The key is having a basic grasp of the basics so that you won't feel like a toy boat facing Niagara Falls. And that's just what this seminar is all about. I don't mean that you'll become a financial expert overnight, but you will be able to knowledgeably discuss financial issues with your accountant, your attorney, and your barber or your hairdresser. Over the 3 programs in this series, we will discuss the choices every investor faces and the role risk plays in the investment process. In this first seminar, we will examine the threats to your financial well-being and then what strategies you can take to help you sidestep them. After that, we'll review diversification strategies for your investment portfolio, and then we'll look at some of the most common investment types and vehicles.
Each program has a limited time slot, and it's impossible to jam everything Michael has learned in 30 years into 30 minutes. Now, not all members of our audience have the same level of financial knowledge, so we do ask those experienced investors to be a little patient as we bring all the viewers up to speed. We will quickly be covering more advanced material.
Now, a television seminar like this can be a very effective way of communicating, but it has some drawbacks. Let me give you an example of what I mean. An older gentleman tells his friends that he's afraid that his wife may be losing her hearing. His friend says, why not test her? Stand 20 feet behind her and ask her a question. If she doesn't answer, then keep moving closer and try again until she hears you. The first man says, terrific idea. When he gets home, he finds his wife in the kitchen stirring a pot on the stove. Standing 20 feet behind her, he says in a normal voice, honey, what's for dinner? No answer. So he steps 5 feet closer and asks again. Still no answer. Another 5 feet closer and still nothing. Finally, 5 feet away, he asks, honey, what's for dinner? She turns around and looks at him strangely and says, Harry, for the 4th time, beef stew. Now, that story is like this seminar. I want to give you very valuable knowledge, but because I can't see or hear you, I can't be sure I'm getting through. And you want that knowledge, but because you can't ask questions, you may not be getting the answers you need.
So your questions can benefit everyone in the audience, but there just isn't enough time in this first seminar. No problem, just jot them down and send them to the email address at the bottom of the screen. We will try to answer them during the next program or by email. Please keep in mind that by law, Michael and every other registered investment advisor cannot discuss individual securities or investment ideas without first meeting with you to understand your individual financial situation. Just as a doctor can't prescribe medication without an examination, Michael can't make any recommendations without first getting a thorough picture of your unique circumstances. If, however, you have pressing concerns about your current investment situation, you're welcome to call the number below for a personalised, no-cost second opinion. mention that you saw this seminar, and Michael will provide you with a comprehensive ethical portfolio analysis report. Now, some people say investing is like gambling. How do you feel about that statement?
Well, investing is a business decision, not gambling. The only aspect they have in common is an element of risk. But in gambling, the odds are always heavily against the gambler. Those casino palaces weren't built by parking fees. Gambling is when you place a bet on a risky outcome. If you're wrong, you lose 100% of your money. Let me tell you why this does not have to happen with your investments. Investing is a business decision based on a company's performance and professional evaluations of its potential for future growth. When you invest, you're buying part ownership in a company, not guessing which horse will run fastest or who has the best cards or guessing the next lottery number. A company has value as an operating business concern with products and employees, equipment, customers, and cash flow. Investing is not an all or nothing bet. I act as a steward of my clients' assets. People invest because they want to see the value of their portfolios grow. But investing carries risk. And in my role as steward, it's just as important for me to protect them from losses. In my practice, we approach this by first working one-on-one with each client to help them clearly spell out their investment objectives and the percentage decline they feel they can comfortably tolerate. We then assemble a portfolio of securities designed to help them attain that objective. No matter how well an individual security may perform, based on my experience, one thing you can be sure of, there is no guarantee that it will continue into the future. As a safety net to preserve a client's capital, we place stop-loss sell orders in our computer system for each of the stock positions based on my proprietary methodology. As the security increases in value, we progressively raise the stop price. Should the value decline below the stop-loss price, it triggers the computer system to automatically sell the security. If the stock is appreciated, the client walks away with a profit. But even if the sale results in a loss, the loss will be limited to the percentage set by the investor. So unlike gambling, investing is not an all or nothing bet.
So the security is automatically sold if it falls below the stop limit. I mean, that seems like a reasonable approach to limit the downside risk. But what are some of the other risks that our viewers can identify with?
Well, many of our viewers probably already have investments in retirement accounts and feel fairly comfortable about their future. Most successful people have such busy lives that they can't always keep track of their monthly statements, no less manage a large portfolio on a daily basis. So inattention or neglect of your assets is a threat that you might avoid by enlisting a professional advisor. Remember, your money is your life. However, no matter how much money you have saved, there are major threats that can erode your future financial well-being. Some are predictable, some are unavoidable. Some come under they're just unexpected completely, but they all come under the same heading, running out of money. This session will focus on those threats and present strategies that might help you protect yourself or sidestep them. Let's examine the 6 most credible threats that cause people to run out of money. The first is outliving your money. The second, Social Security and other pensions may not deliver. 3 is misfortunes like accidents or serious healthcare expenses. The 4th is inflation. The 5th is taxes. The 6th is poor investment performance. And finally, the zombie apocalypse. Now, it's the most popular show on television, and I bet many of you have already met a few zombies.
Well, I can't say I've met any zombies just yet. But the apocalypse is a remote possibility, I suppose. So maybe let's start with something a little bit more realistic, like outliving your money. So according to the US National Center for Health Statistics, we're likely to live longer than any generation before. Data compiled by the Social Security Administration shows that a man reaching age 65 today can expect to live on average until age 84. For a woman age 65, it's 86. Now this sounds like good news, but that's 20 to 30 years past the traditional retirement age. And the longer you live, the more money you need to maintain your quality of life. So what happens if your money runs out before you do?
When it comes to outliving your money, here's something to think about. Based on these statistics, you could spend more years in retirement than you did working. Could the money you saved support your current lifestyle longer than the many years it took you to earn it? In Florida, I've seen really elderly men bagging groceries in supermarkets. I know they aren't doing it for the exercise. So living to 85 or 90 or 105 could be heaven, or it could be a painful, humiliating ordeal. Sound investment decisions now could make the difference.
So most people think that when they retire, they can fill the gap with Social Security. Unfortunately, no matter how much you earned during your career, the maximum Social Security retirement payment in 2016 is $2,600 a month. Now, anyone living in this area would find it very hard to survive on $2,600 a month. Plus, we've all heard that Social Security has money problems, but it's more serious than most people realize. The Social Security Administration projects that by 2022, the trust fund will start paying out more money than it takes in. That's just 5 years from now. And the trust funds will be depleted by 2035. That's 18 years away. That year, if no changes are made to the current system, Social Security will only be able to pay back approximately 77% of the benefits owed.
Bottom line, the younger you are, the less you should count on Social Security. In fact, many advisors counsel clients 50 years old or younger not to count on Social Security at all. Taking all this into consideration, it would be sensible for you to have additional channels to build your retirement.
So I've heard a few TV commentators tell people to maybe defer from taking Social Security until they're much older, and that way they should be able to get higher monthly payments.
Well, the advice I give my clients is to start taking those payments as soon as you're fully eligible, except if it would put you in a higher tax bracket. Now, I want to be clear. I think Social Security is a great program. However, I don't agree with referring to it as an entitlement program because that twists its true identity. It's not some government handout. That's your money. Social Security payments are actually a partial refund of retirement money that you are required to hand over to the government from every paycheck you ever received. If someone owes you money for 30 years and then offers to pay you back, I think it's simply good sense to take it. By the way, did the TV guy mention how much money you're passing up by waiting just 4 years from 66 to 70? Let's do the math. At the max monthly benefit of $2,600 times 4 years or 48 months, you would have received $126,700. Is it worth giving up years of cash payments, gambling that you might ultimately live long enough to collect a few extra bucks? If you die, before then, or if Social Security goes broke, you and your family might get nothing of the money you put away all those years. Even if you don't need the money, take it anyway. I'll show you how to build a trust fund for your grandchildren. Now, these are my observations, and you probably haven't heard anything like them before on TV or anywhere else you're getting your financial advice. But once again, I think Social Security is a terrific program. It's consistent, risk-free, inflation-adjusted lifetime benefits would be very hard to beat. I just try to show my clients how to make the most of it. However, everyone's situation is different. You should consult your own tax advisor before making any decision regarding your Social Security.
So taking all of this into consideration, it seems that you're saying that people should look for alternative ways to build their retirement.
That just makes good sense, to do all you can to be self-sufficient. Here's more food for thought. It's not just your standard of living that you have to worry about. You have to remain healthy and financially sound, not just for yourself, but for the sake of your children and grandchildren. If you deal with young people, you know they need your guidance. Also, you must help those children get a good education so they'll have rewarding careers, so they'll stop asking you for money. It'll be harder for them than it was for us because education costs have been rising even faster than inflation.
Well, I feel that's something that I know something about. According to the College Board in 2015, total charges for just 1 year of an in-state public college, including tuition, fees, books, and a room and board, average almost $21,000. 1 year of private college has an average price tag of over $45,000.
Well, beyond future college expenses, you may need to set aside substantial investments for other family needs, such as weddings, first home down payments. Now let's look at what I consider the biggest threat to your financial well-being, and that's inflation. Inflation is a silent thief in the night. As an example, in 1985, the average price of a loaf of bread was 57 cents. I'm sure your wife is shocked. So you could buy 2 loaves of bread for as little as $1 versus $1.43 for a single loaf of bread in 2015. The price for a gallon of regular gasoline went from $1.21 in 1983 to $2.06 in 2015. In 1985, a couple could enjoy a movie together and have a little left over for the same cost as one adult ticket in 2015. Why does this happen? Let's use the price of bread as an example. In 1950, no kidding, it was 20 cents a loaf. In 2013, it was $3.20 a loaf. That's a 1,500% increase.
But how can that actually happen? Because the ingredients within bread, you've got flour and water, they haven't really changed much, definitely in the last few years or at all. So what could possibly make bread 1,500 times more expensive today?
Inflation is a word that means expansion. However, its meaning is distorted in the economic parlance to really mean a decrease in the purchasing power of the dollar. It's not that the ingredients in bread cost more, it's that the dollar buys less. And it takes more dollars to buy bread as a result. Now, from 1948 to today, the purchasing power of a dollar has dramatically shrunk to 5 cents on an inflation-adjusted basis. 5 cents. Recently, you could have picked up have you been in a store, picked up a commonplace item, looked at the price, and put it back after saying, that price is outrageous? That's inflation. Day by day, year after year, inflation robs you. Excuse me. Because when the dollar declines in value, the dollars in your pocket don't change color or shrink in size, so you're unaware of the change until you have to buy something. Then you realize that it takes more dollars to buy everything at prices higher than they were the year before. Are you ready for that? Because it's not just bread. Everything from food to electricity, from car repairs to shoes will cost more too. Inflation is waiting for us. Ask your grandfather and he'll tell you. Back in the day, he could buy a house for the money it takes to buy a car today. And that's why 75-year-old men who worked all their lives and retired on a fixed income are now begging groceries to keep their heads above water. I don't want you to be in that position. But wait, it gets worse. If inflation is a sneak thief, then his partner in crime is taxes.
I'm still reeling from the inflation, and now you're going to hit me with taxes as well.
Well, as Arnold said, don't be afraid. I'm here to protect you. Most people just don't realize how inflation and taxes work together and how much you have to earn on your investments just to break even, much less get ahead. Now, as an investment, as an example, I want to show you how if you invested $10,000 at 4.5%, you would earn $450 a year. Long-term historical inflation rate is 2%. So that would take away $200 in buying power each year. Now there's a lot of numbers here, so I'm going to go slow. In other words, what $10,000 bought 1 year ago now costs $200 more, or $10,200. Then there are taxes on the interest you earned. Even at the lowest tax bracket of 28%, the IRS would take $126 for income taxes on the $450 interest you earned. That would leave you with $324. Subtract 200 lost to inflation, and you're left with $124. So bottom line, your net is only 1.2%. The IRS and inflation each got a bigger chunk of your money than you did, and we haven't even considered state taxes. It's even worse in the higher tax brackets. Basically, a wise investment plan has to help you beat inflation and to minimize your tax obligations.
Okay, so now I know why I feel so overworked and underpaid. Let's pause for a review. We've looked at the importance of investing. We recognise that we are living longer and will need our money to keep pace. We've examined the major threats to our financial well-being, except the zombie apocalypse, but uncovered some disturbing information on Social Security, identified the whole inflation and taxes put on your money, and why, therefore, we need alternatives.
Before we move away from taxes, I'd like to give our viewers some help in that area with a useful free gift. It's a tax planning guide for the current tax year, and it's loaded with valuable information. Key dates, when to file certain documents, the best time to do a Roth IRA, conversion, tax schedules, exemptions, phase-out retirements, count limits, Social Security tax rates, Medicare tax rates, gift tax exclusions, and lots more. Tax season is an excellent time to review your financial picture. In some ways, it forces us to look at the past year and focus on where we could do better going forward. Now, each year in January, I send these out to my clients, and I have a few hundred left over. I'm a financial professional. I know all this stuff already, and I still find it informative.
If you would like one, just send the words tax guide with your name and address to the email address shown on the screen below, and we will send it to you. No charge, no strings attached. But the number is limited, so it's first come, first served. It may even make it easier for you to work with your accountant. So now that we're familiar with the major challenges, what can our viewers do to overcome them?
The best way I know is to develop a prudent, intelligent investment plan. Now, a good investment plan should help you, one, define your financial goals. You've got to know where you're going before you can start out. Outpace inflation, reduce taxes, set up an emergency fund for the unexpected, manage investment risk, and enrich your retirement.
So how can an investment plan help people reach their goals?
Think of an investment plan as a blueprint for your financial life. For something as important as this, I would encourage people to enlist the help of a financial knowledgeable professional. Because of the legal limitations on me, the best I can provide to our audience is a general outline for starters. You have to determine how much time you have to reach your goals and how much risk you can tolerate along the way. The biggest factor relates to your stage in life. Logically, the younger you are, the more time you have. The older you are, the less risk you should take. For the sake of simplicity, let's just characterize investors into 3 stages of development. Builders, younger than 35 years old. Providers, age 35 to 50. Independents, ages 50 years and older. Now, each group has specific issues. Let's take a look at a few of them.
So if you're younger than 35, then you're really just getting started.
Yes, that's right. And if you're in that category, you'll have a lot of out-of-pocket expenses. You'll need to acquire all the things it takes to set up an independent lifestyle. Before you can start seriously saving and investing, you must reduce and manage your short-term debt. This probably includes paying an auto loan, a mortgage, perhaps some college loans, and more than likely some credit card debt. It's also important to acquire insurance to cover things, among others, your family's health, your life, your car. And finally, you need to begin a systematic investing program. Even a little can build to an impressive sum over the years. Because you're building over a longer period of time, you can focus on growth, not income. And one more thing. If your employer offers a 401k, a 403b, or any other workplace savings program with a matching employer contribution, tomorrow, first thing, sign up. This is free, tax-sheltered money, and as a bonus, it could lower your current IRS bill.
So how would you recommend the 35 to 50 category invest their money?
Now, I think of this group as providers. The expenses of raising children may be a big concern. Education is definitely a big issue these days, whether it's a private secondary school or college. Then there are those other big ticket expenses such as weddings and vacations. And you can't forget your own retirement funds, emergency savings, and insurance coverage. For all these, you'll want investments that offer a balance between growth and income.
So then there are those that are aged 50 years and older. What approach would you suggest for them?
Now, I see people in this class as independents. You've learned a lot, you've overcome most of the big challenges in life, you'll be paying down your long-term debts, monitoring your investment portfolio, and adjusting your retirement investments. Maybe you'll be traveling, buying a vacation home for the whole family, so your kids and grandkids can spend more time with you. Perhaps helping your new young doctor or lawyer or an entrepreneur set up their own business. Your medical coverage will need a review. And you'll be focusing on estate preservation issues and maybe establishing a legacy. It would be wise to transition to more conservative, less risky investments because, common sense, it'll be harder to recover from any losses and rebuild a fragile nest egg. Your retirement plan should include diversifying your investments and moving from growth to an emphasis on steady, dependable income. In addition, before you invest, you should have adequate insurance to help protect your income and estate. Now, we're going to defer that conversation and cover insurance later in the series.
Okay, so now we're actually getting to the heart of the matter. How would you advise people to invest their money?
I want to state straight out that I primarily invest in American companies because I understand them better than I understand companies in Thailand or Yugoslavia or Zimbabwe. I have a few investments selected in companies that are in other countries, but on the whole, I favor American companies because, one, I have a clear understanding of the accounting rules here. Second, I can depend on the laws that govern our security markets. Third, consistently, decade after decade, America has been the most innovative country and has provided investors with the best, most stable returns. Plus, and this is a big one, I invest in America because I want to grow American prosperity. If you or someone you know has ever been out of work in America, you know what I mean. Our nation used to have companies that were concerned about how well their community thrived because of them. Not so much anymore. Hopefully, as shareholders, we can change that back. Now back to our story. There are three broad categories of investment vehicles: stocks, bonds, and cash alternatives. Let's run through each of their characteristics. Of the three major asset classes, stocks offer the best potential for growth and can play an important role in almost any portfolio. When you buy a stock, quite simply, it means, as a stockholder, you're a part owner of that company. You may also be entitled to a share in the profits if it pays you dividends. A dividend is a payment that is distributed to each shareholder for each share of stock they own from the profits of the company. Stocks historically have shown the most attractive returns on investments. Stocks offer long-term growth potential, but may fluctuate more and provide less income than other investments. The downside of stock investing is that they can be volatile, which means greater risk. The stock market is often driven by emotion, not logic. And that makes it very hard to predict which stocks will do well and which won't. We'll be talking more about stocks in the next session. Now, a bond is a debt instrument. It doesn't represent ownership position. When you own a bond, you're simply lending money to the issuer, such as a company or a federal or local government. They promise to pay you a fixed amount of interest, usually twice a year, for a certain length of time, and to repay the bond's face value at maturity. The issuer is contractually obligated to pay you that same fixed amount, usually twice a year until maturity, and then repay you the bond's face value. For example, a bond with a $1,000 par value, and that's usually most of them, and a 5% coupon, which is the rate of interest, will pay you $50 a year in interest until maturity. In fact, bonds are referred to as fixed-rate securities. Now, bonds usually serve two important functions within a portfolio. First, because bond prices generally are less volatile than stocks, bonds give a more stable value to a portfolio. Secondly, because they pay interest on a regular basis, bonds provide income. For these reasons, conservative investors who seek stability and retirees who need income often have bonds as a significant portion of their portfolios. Regardless of the price paid for a bond, the amount of interest the owner earns remains steady based on the bond's par value. As in our example, a bond with a $1,000 par value and a 5% coupon will pay $50 a year in interest, even when the bond's market prices rise or fall or dips below the par value. You'll still receive $50 annually. Now, several factors can influence a bond's market price, including a move in market interest rates or a change in the issuer's credit rating. Generally, When market interest rates of newly issued bonds rise, the price of existing bonds fall. Now this happens because the income they pay is less than what the investor could receive in the new bond. When interest rates fall, existing bonds go up because the income they pay is more than what investors can receive on the new bonds. Now, there's an easy way to look at this. Imagine a seesaw. When one side goes up, the other side goes down. If newly issued bonds offer a higher rate of interest, the price of existing bonds go down. When newly issued bonds offer a lower rate of interest, the price of existing bonds go up, like a seesaw. Now, we'll talk more about bonds in a future session.
Okay, so that's stocks and bonds. So what about cash alternatives?
Okay, the cash alternatives include a category of money it's short-term instruments, really, such as checking accounts, savings accounts, bank certificates of deposit, and money market funds. Now, these generally can be used as like a safety hold for funds in anticipation of maybe new investment opportunities or emergency funds, things of that nature. And cash alternatives are usually the least volatile investment. However, because of their low return, you risk having your money eroded by inflation. The money you withdraw may actually have less value than when you originally deposited it. There are also mutual funds and ETFs, which are exchange-traded funds, which can be thought of as like baskets of stocks or bonds. And we'll examine them in greater detail in session 2.
Okay. Michael, could you give us a view of how sort of stocks and bonds actually function in the real world?
Sure. Let's take a look behind the curtain and see what happens in a corporation. Assume 100 of us want to start a corporation that manufactures easels, okay? So we need $100,000 to start the company. We apply for a charter for the easel corporation from the state. We authorize 20,000 shares of common stock. We issue or sell 10,000 of them for a price of $10 each share. That leaves the remaining 10,000 shares unissued, okay? We each buy 100 shares for $1,000, and we've raised the $100,000, which we needed to start the company. For every share that each of us owns, we have one vote at the shareholders meeting, okay? But none of us have the time to run an easel factory. So we elect 5 people to represent us as the board of directors, and one person to head it as the chairman of the board. They don't have the time to run the company either on a full-time basis, so they hire permanent employees, a president, a vice president, department managers, and so on. This makes the president responsible to the board of directors and the board of directors responsible to us as shareholders. Soon we discovered that we could really increase our profits if we had another $100,000 to buy new equipment. We could sell the other 10,000 shares of unissued stock, but we think that we could lose control of our company if we invited new investors. So instead, we borrow the money by selling corporate bonds. We sell our bonds in $1,000 denominations and agree to pay interest semi-annually. We take on the obligation of making sure that the bondholders receive that interest every 6 months so they don't foreclose on our corporation. We also make provision for them to get back the $100,000 they paid when it matures. So there's 2 major types of corporate bonds that are available to investors. There are secured bonds, which have a specific asset pledged against them, such as real estate or equipment, and that's collateral. Unsecured bonds do not have a specific pledged asset. Instead, they're merely backed by the issuing corporation's good name and creditworthiness. Investors who buy these bonds normally receive a higher yield because those bonds actually represent a greater risk. Now, I hope that that example gives you a better understanding of the place stocks and bonds play in the business world.
Yeah, it definitely helps. But I think the question is really, how do our viewers then decide which are right for them?
Okay, Emily, a prudent investor should consider 3 qualities when looking for an investment. It has to be relatively risk-free, or at least have tolerable risk. It should have liquidity, which means you can buy and sell it easily. And finally, it should have growth potential. But no single investment can do it all. It takes a combination of diversified investments, and we can create that combination by a strategy called asset allocation. Now, asset allocation doesn't eliminate market risk. What it does is it helps you blend these investments from these different asset classes in certain proportions to help you manage your investment risk and work towards your long-term investment goals. It's Wall Street's version of not putting all your eggs in one basket.
That was a lot of detail on some very important investment information, and we still aren't finished with this first seminar. You are welcome to submit your questions to us at the email address below, and we will try to answer them during the next program or by email. Now remember that Michael is not permitted to recommend individual securities or investment ideas without first getting a thorough understanding of your unique financial situation. Once again though, if you do have pressing concerns about your existing investments, you are more than welcome to call the number below to arrange for a personalised, no-cost second opinion. Mention that you saw this seminar and Michael will provide you with a comprehensive, unbiased portfolio analysis report without cost or further obligation. If you forget the number, just Google Michael Wayne Fineman and his website will be the first result that pops up. So Michael, how does asset allocation relate to the three groups of investors that we discussed earlier? So that's the builders, the providers, and the independents.
Okay. To determine an appropriate asset allocation, you need to look at three important factors. Your financial goals, that's the place to start. Your time horizon, and your risk tolerance. All of these factors weigh into the choice of where you'll invest your money. And your portfolio should be allocated to some portion of each of these three investment vehicles, the stocks, the bonds, and cash alternatives, based on your financial stage, the characteristics of your financial stage. Now, here are three hypothetical asset allocation strategies that tend to match each of the groups we discussed. In general, builders, those under 35, should think about following a growth asset allocation model. Perhaps investing 75% of their funds in stocks, 15% in fixed income securities, and 10% in cash alternatives. Providers, those 35 to 50, often need to balance their asset allocations between growth and income, perhaps investing 50% in stocks, 40% in fixed income securities, and 10% in cash alternatives. Independents, those 50 years and above, usually need to lower their exposure to risk and strive for an income asset allocation, perhaps investing 60% of their funds in fixed income securities, 30% in stock, and 10% in cash alternatives. You still need the stock for growth.
Of course, all of these models are general guidelines. Your asset allocation should be individualized to your situation. These are really more for illustrations for informational purposes only, and not intended to represent an actual investment allocation. Now, Michael would need to review each individual's unique situation before recommending any investment allocation. We've covered a lot of information, calculations, concepts, and I know that the next seminar session will be even more in depth with ideas and information. If you have any questions, please do send them to michael.fineman@wfadvisors.com. So we've come to the close of the first Dollars and Cents Investing, the Fundamental of Investing seminar. Before we go, I have a question for you to ponder on until the next session. Would you rather have $1 million in one lump sum, or starting with a penny, an amount that doubled every day for a month?
We'll give you an answer and an explanation during the next seminar in this series.
Please watch or call this station for the date and time for the next seminar in this series. Michael, thanks for coming. It's goodbye from me.
Goodbye from me. Together, we can make tomorrow even better than today. See you next time.